Hello, how are you? I'm Dr. Labib from Dr. Labib Academy. Today we are going to continue from where we have left ACCA strategic business reporting. Okay, this is with respect to I will want to make sure that where we yesterday we have started in the previous session we have done with respect to foreign currency in individual financial statements. Okay, we have done yesterday the concept of foreign currency, what is the functional currency, what is the presentation currency, and monetary items, non-monetary items. Is that how we have to deal with monetary items and how we have to deal with non-monetary items. I kindly request you all, please subscribe to my channel, share my channel, and watch till the end. Is it right? Very, very important, so that we can reach to as many students as possible. This is the series with respect to 15 out of 21. The 21, the one will denominator will change as per the requirements, how we are going to work it out. Okay, but please make sure that when you are following the things, you follow in a sequential order. Okay, that makes you more you can follow in a very sequential order. You can understand how we are going to proceed. I am following the Kaplan. Okay, first we'll do the study text. Concepts are clear. You can do the problems as much as you wish. Okay, but most importantly is concept has to be clear. This is now when we are doing this. This is with respect to what? This is with respect to chapter 7. Okay, this is with respect to chapter 7, foreign currency in individual financial statements. Okay, now please subscribe to my channel, share this channel, and watch till the end. That's very, very important. Okay, and post your comments, what you think, how you are benefiting from it, how it is useful, and how best we can make more interesting and more understandable. Coming back to this, is that highlight is an entity whose functional currency is in dollars, has an annual reporting date is how much? 31st of December. On July 1st, they have purchased. Okay, they have purchased. When you are saying it is purchased, mostly, okay, an item of plant and equipment on credit means when it has been purchased, it means it is going to be what? It is going to be payables. On November 1st, 2003, they made a payment of 180 DN to the supplier. The balance of the invoice remains outstanding. Okay, they got it 400 and they paid 180. Very simple, very straightforward. We can score good marks here. Okay, Highlight has a policy of applying historical cost accounting and depreciating plant and equipment at the rate of how much? 20%. The plant and equipment is not expected to have any residual value. Fine. We are focusing here what? We are primarily focusing here on payables. Okay. Make it sure the primary focus is on payables. Okay. They have given the exchange rate of July 1st, November 1st, December, and 31st December. Okay. Prepare the extracts from highlight financial statements for the year ended 31st December. See the thing. When their reporting date is how much? Reporting date is 31st December. When they have purchased on 1st of July. Means 1st of July till 31st December. How many months are there? 6 months. This makes the difference. Okay. Whenever we are going to consider this as a in terms of what they say about depreciation also. Means we have to calculate depreciation for 6 months. Fine. Now, what happens is that solution. That's step 1. See, I will follow this. This is the way I will teach. Okay. I will put it as stepwise so that it will be easy for you to understand. Now, when we do the things, when they have purchased on 1st of July, and they have paid 1st of November. See, difference between closing balance and the amount settlement, how much we have settled, definitely there will be some difference because in this process, whenever you are doing this, is it right? In this process, whenever you are making a conversion, what will happen? There will be a exchange loss or exchange gain. Okay, this is the first one, point number A. The second one is what? The second one is, we will cover this once we have done with the first one. We will go to the second one. Now, very simple, don't waste that much time here. Okay, we have to, now we have to first put the date, is right? Then we have to talk about the particulars, is right? Write some heading on that. Okay, that makes really presentable, is it right? Statement showing exchange gain or loss. Okay, is it? It will make some. See, in examination, presentation also matters a lot. Okay, when you are doing computerized on computerized examination, then it will be more easy to make it bold, to make it all those things. Is it right? So, dates, particulars. That the transaction currency is DN. You have the rate, and you have to work out with the functional currency of dollars. Okay, this is the functional currency. Make it a point. Okay, this is the we have to ultimately we have to make sure that it has to be converted into functional currency. Very easy. It's not difficult at all. First of when it has been governed, 1st of July. Is it right? 1st July 2003. Okay. Now payables recorded. Is it right? Payables recorded. They have purchased. Is it right? Payables recorded. Why happened? It is because they have purchased on credit. Okay. How much is there? They have purchased on how much? 400 DN. Okay. What is the rate? What is the rate here? They have mentioned the rate. Is it right? On July it is how much? 10 DN. Rate is how much? 10. Okay. 10 DN. You have to write. Okay. That's very important. This is column 1. This is column 2. This is column 3. This is column 4. And this is column 5. Okay. Column 5 equal to 3 divided by 4. Okay. Column 3 divided by column 4. How much is there? 400,000 divided by 10. It comes to how much? $40,000. Okay. $40,000. Now, they have made a payment. Is it right? They made a payment. How much they made a payment? On 1st of November, they made a payment. Is it 2003? Is it right? How much? Part payment. They have not paid full. They have paid part payment. How much they have paid part payment? They paid a part payment of 180 DN. Okay. What is the rate of 1st November? 7.2. Is it DN 7.2? 180 divided by 7.2. It comes to how much? In terms of dollars, $25,000. How much is the balance? Balance is $15,000. Is it right? $15,000. Fine. This is yet to pay. Is it right? Yet to pay. But what happening? You will have the closing balance. Is it right? 31st November 2003. Closing balance. Closing balance should be how much? See, you have to take the closing balance of DN. Is it right? It comes to how much? Closing balance of it is 400 minus 180. It comes to how much? It comes to 220. And what is the closing rate? Closing rate is how much? Closing rate is 8. Is it right? Closing rate is 8 DN. And if you convert it into how much, it will come to 27,500. Okay. Means you have to pay this much. But what happening? See, as per the current rate, as on the rate of 31st December, how much you have to pay? 27. But what balance you are showing? 50 means you are going to pay more. Is it right? How much you are going to pay more? You are going to pay more, 12,500. This is called as exchange loss. Okay, exchange loss, difference. Is a difference is nothing but exchange loss. We are going to show it profit and loss account. Okay, we are going to show it in profit and loss account. Fine. Now, what are the things we have to show in the financial statement? In the financial statements, what are the things we have to show? We have to show exchange loss. Is it right? We have to show exchange loss. They say that there is a depreciation. Is it right? We have to show how we have to show depreciation. Depreciation is how much? 40,000. Is it right? They have mentioned anything? They say that applying a historical cost rate at 20%, the item of plant is not expected to have no residual value. Is it right? Means how 40,000. Is it right? For how many years we have purchased this? For how many years we have purchased the item of plant is not expected to have any residual value at the end of its useful life. Okay, at the end of its useful life, they have not mentioned anything. Is it right? Just see purchase on one made payment highlight. No, they have not mentioned anything. Fine. Okay. If that is the case, is that 6 by 12 because it is for 6 months. It is a 6 by 12 at the rate of how much? At the rate of 20%. It comes to how much? If you take depreciation, 40,000 times 6 divided by 12 times 20%. Okay, it comes to how much? It comes to 4,000. Okay, it comes to. Now we will do that. Okay. We will do that. Put this one as the first one. Next, step 2. Is it right? Step 2. Straight away you can do. Okay, you can do straight away. Nothing has happened. Extracts. Is that extracts of the financial statements? Extract of the financial statement for the year ended 31/12/2003. Okay. This is step 2. Now coming to the profit and loss account. Profit and loss account. Okay, profit and loss. What we have to show in profit and loss account? See, whenever we are talking about the depreciation, okay, usually at this stage we have done so many times. Okay, depreciation will be shown in cost of sales. Okay, under the category of cost of sales. Okay, how much is the depreciation? We have calculated depreciation. How much is that? Again, I am putting here $40,000. Is that $40,000 times 20% times 6 by 12? It comes to how much? It comes to 4,000. Next, exchange loss is there. Is that exchange loss is there? How much is the exchange loss? We calculated here 12,500. Is right? 12,500. Just put it in brackets. It reflects that it has to be deducted from the revenue. Okay, it has to be deducted from the revenue. Next, coming back to this, what we have to do? We have to take into consideration statement of financial position. Please subscribe to my channel, share my channel, and see till the end. Is that for you only? I'm just making says you should get benefit from this. Okay. Next, what is the statement? How much is the property, plant, and equipment? Property, plant, and equipment is how much? And equipment is that we have that equipment. How much is there? 40,000. How much is the depreciation? Depreciation is 4. What is the value? 36,000. Fine. In the current liabilities. Is it right? In the current liabilities. This is part of what? Non-current assets. Is it right? In current liabilities, what we have to do? We have to say payables. How much is the closing balance of payables we have done here? Is it right? How much is the closing balance of payables? Closing balance of payable is 27,500. Is it? This is in terms of payables. Okay, means now we can say, see what happens when you were based on the exchange rates. We are going to pay more. Is it right? Where based on the exchange rate compared to the spot rate, the payment is in terms of dollars is higher than the date of purchase. If the payment is higher than the date of purchase based on the dollar rate, exchange rate, definitely there will be a loss for the firm. Okay, this is where we are very much concerned. Coming back to this, what it says, question number B. During 2003, entered a number of transactions with an overseas customer. On November 1st, Highlight made a credit sales. When you are talking in terms of credit sale, see the thing, receivables. Is it right? Receivables. Same thing is there. Is it? So we have to think whether how much we are going to receive and how much you are going to, if you are based on the exchange rates, if you are receiving more, it is a gain. Based on the exchange rate, if you are receiving less, is it right? It is going to be a loss. Fine. Now, exchange rate loss, that's all. How much they have made a credit sales of 3 months, credit for how many? 360. On December 1st, 2003, Highlight made a further credit sale, 540. By 31st December, Highlight had received no payment. Fine. They have received, and as the receivables were still within the credit period. They are not regarded. See, that is the reason. How many months they are saying? It is for 3 months. Is that November, December, January? Means it is going to be till when it is going to be 30. It is going to be this period is the sales done on November 1st is valid till 31st December. Okay, sorry, 31st January. 3 months, and the sales of 1st December, again as simple as that. Whatever the terms and conditions. Okay, whatever the terms and conditions. Now, based on that, there are two sales are there, is it right? There are two sales. We have to follow the same thing, is it right? Solution, is it right? Solution. What they are asking us, relevant exchange rates as follows. Prepare the extracts. The same thing, how we have to do in the profit and loss account and how we have to do in statement of financial position. Step 1, okay? Step 1. Okay, step 1. In the step 1, take it apart. Statement showing exchange rate gain or loss. Okay, gain or loss. My handwriting is not that much good. Okay, now first, but follow date. You have particulars. Is that you have particular DN? Is that rate, and functional currency is what? Functional currency is in dollars. How the things will work? This is column 1, column 2, column 3, column 4, column 5 equal to 3 divided by 4. Is it right? Column 3 divided by 4. What they say, the first you go, 1st of November, okay, 1st of November 2003. Is that it is receivables? Is it right? It is receivables. Is that receivables? How much is receivables? 360. Okay, 360,000. What is the exchange rate of 1st of November? The exchange rate is 7.2. You convert it into dollars, it will become how much? 50,000. Again, there is a further sales. No, 1st of December. Is that there will be further sales of 1st of December. How much is the further sales? 540. Is it 540? And what is the exchange rate on 1st of December? The exchange rate is how much? 9. Okay, the exchange rate is how much? 9. It comes to how much? It comes to 60,000. This is in dollars. Okay, this is in dollars. I have written here dollars. Okay, now that's all is there. Okay, first you can put it here. How much is there? Dollars is 110. Okay, how much here it is? How much? It is 900,000. Okay, now take the closing balance. Okay, 31st December 2003 closing balance. Here you have to be very immediately you are doing back to back from payables to receivables. the rule will change. Okay, it will be reciprocal. Closing balance is that this is the closing balance. Fine, this is the closing balance. How much is the closing? See, you put like this. Closing balance is how much? Closing balance is 900,000. What is the closing rate? Closing rate is how much? Closing rate is 8. Okay, closing rate is how much? Closing rate is 8. 900 divided by 8, it comes to how much? It comes to is that it comes to how much? It comes to 112. See, you have to receive this much. How much you have to receive? You have to receive 112,500. Okay, you have to receive 112,500. How much it is showing? 1110. You are receiving more. Okay, you are receiving more. The difference is what? The difference is that very clear? You actually, as per the current exchange rate, it is 112,500. Fine, but how much is there as per the the rate as per the transaction date? 110. How much is the difference? Difference is 12,500. You are going to receive more. Okay, you are going to receive more. If difference is 12,500, this is what? This is called as exchange gain. Is that? It is called as a exchange gain. Okay, how much is the exchange gain? 12,500. Now, step 2 is that extracts. Is that extracts of the financial? Is that extracts of the financial statements for the year ended? Please write with me. Okay, it will help you. Ended 31st December 2003. Okay, first you have to mention which one? Profit and loss account. Okay, profit and loss account. In the profit and loss account, how much we have to mention? Revenue. Is it right? Revenue. Sales. Is it? How much is the sales? Total sales is how much? $50,000 plus $60,000. It is presented in functional currency. Okay, it has to be presented in functional, and the functional currency is what? The functional currency is dollars. Next, you have other income. Okay, other operating. You have to mention very clearly other operating income. Is that within brackets exchange gain? Is that within brackets exchange gain? How much is there? 12,500. This is with respect to what? This is with respect to profit and loss. What is the statement? Statement of financial position is how much? Is that statement of financial position is how much? We have to write receivables. Is it right? In the current assets. In the current assets, we have to write receivables. Which receivables we have to take? We have to take the receivables of closing balance. How much is the closing balance? 112,500. Is that? This is the way it has to be. It has to be reflected with respect to. Now we have done comprehensively. Is it right? If you take into consideration, we have done. If I go back from the first one, what we have done, we have identified what is the IAS 21 in terms of functional and presentation currencies. Then we say what are the conditions of functional currencies. Functional currencies is primary. What are the primary factors? Sales. Okay, sales prices are primary factor. Competitive forces which they are using the currency is the primary factor. And in the next is in terms of services also, in which currency we are using. Whichever currency is used for services, we have to give priority to that. Then it comes to labor, material and other costs. What is the secondary factors? Secondary factors are we are talking in terms of the financing activities, from where we generate finance, and we are talking in terms of operating activities, how it has been retained. These are the things we have to be very clear. And we, in the first test we are understanding, we have identified what are the conditions, why it is in the previous sequence 14 series of this SBR, you have the clear explanation on that. Okay, then we are talking in terms of what we are talking about, the how it is going to be settled in cash, what are the exchange differences, and how it has to be treated. Subsequently, we will have monetary items and non-monetary items. What is the conditions of monetary items? Monetary items, it should not monetary items, cash, receivables, payables, okay, and loan. Non-monetary items are non-current assets and inventory. In non-monetary items, we should not we should not retranslate. Okay, we should not retranslate. That is one of the precondition with respect to that. Then subsequently, what we have done, we have taken into consideration how the monetary assets will be treated, and non-monetary assets will be treated as such. Then today what we have done in terms of payables and in terms of receivables. Okay, so make it sure how it will work. Okay, now coming back to this. In every case you will have criticisms. Okay, you can say criticisms, you can say, see, I will not say that. In my view, we can say limitations also. See, is it right? What they say, lack of theoretical underpinning. See, foreign exchange is that forex is very, very high risk cabinet as such. Is right? This area is very high risky, and everyone will have their own assumptions. And it says that from in respect to IAS 21, what is it is not clear why exchange rate gains and losses on monetary items are recorded in profit and loss account. Yet foreign exchange gains and losses arising from foreign exchange operation. We'll see in lecture 20. Okay, and are reported in other. Means why it has been. Means basically when you are talking about the foreign exchange losses, it is only for a current period, is it right? It is only for a current period. This is one of the criticism. It is argued that foreign exchange gains or losses on monetary terms in profit and loss account increase the volatility. Because see, forex is with the variation, is it right? The variability is very high. Is that the variability in movement, is it right? The variability is movement is very high. Okay, and because of that, is that you will have some advantages. Is that if you are talking, see advantages, and you have some disadvantages. Is it right? See the things very simple way. If you are taking the receivables, is it right? If you are taking the receivables, there is a gain. Is it right? There is a gain. But if you are taking the payables, is it right? Is it right? If you are taking the payables, we are going to have loss. Is it? For no other reason. Is it right? For no other reason. But it is part of the activity as such. Is it? What it says, it is argued that retranslating long-term monetary items using the closing rate is not reflect economic substance. Okay, means one side we are talking about long-term monetary items, and one side we are talking about closing rate. Definitely there is an argument, there is a discussion. This is because current exchange rate is being to translate amount that will be repaid in future. Payables. Okay, fine. That is the reason we say it is going to be for what? It is going to be for 90 days. Okay, it is going to be for 90 days. We will take it maximum. Is that 3 months credit? That's all. Is that in either way, in terms of sales or in terms of receivable. But also that is 90 days is not for the foreign exchanges things. 90 days is also a longer period. Foreign exchange gains and losses on long-term basis are highly likely to reverse the repayment receipts. Such gains and losses are unrealized. Means they are saying that how likely to reverse prior to repayment of receipts. Means is there any option is there which we can work it out. This provides further weight to the argument that foreign exchange gains and losses or at least monetary should be recorded in OCI. They say that the rule says that if it is long term, it has to be recorded in OCI. If it is for short term, it has to be recorded in profit and loss account. There is an argument. Is that everyone have their own way? Is it? That is the second point. What the third point says? The third point says that IAS 21 does not stipulate how to determine the average exchange. There is no hard and fast rule. Everyone will have their own way of assumptions. You are doing transactions for almost all working days in a year. Is that all working days in a year? Then which rate we have to take, or average rate, which we have to take the closing rate, which you have to take at the reporting date. If there are so much variations are there, that is one of the things. I mean, they say that does not stipulate to determine the average exchange rate in the. This increases the potential of entities to manipulate the net assets. See, to what extent we can restrict, is it right? It is one of the, this is one of the criticism or one of the limitation. The use of different rates will limit comparability. Definitely what will happen, prices are increasing. See, receivables, you are on the gaining side, payables you are on the losing side. Is that so that there should be inconsistency? What the rule says, when you are talking about the conceptual framework, is it right? When we talk about the conceptual framework, the rule says that there should be reliability. Is it right? The rule says that there should be a reliability. You have to present faithfully. Is it right? You have to have a comparability. Is it? And you should have, most importantly, there should be consistency. The distinction between monetary and non-monetary can be ambiguous and would not benefit for further clarification. See, on what basis it is? See, inventory. We say inventory is a non-monetary item, but inventory is part of the current assets. Is it right? It is part of the current asset, but inventory has been classified as a non-monetary item. There is a big argument which is going to be worked out. If IAS to a restrictive definition of foreign operations, is that what we have to make? A foreign operation is a subsidiary, a foreign operation in terms of associate, joint venture or branch whose activity is based in a country or currency other than the reporting entity. Means that you have to be very specific. It is argued that IAS 21 should instead use a definition of foreign operation that is based on substance rather than legal form. Means when you are saying it's a foreign operations, you have to see what will happen. Joint venture, is it a joint venture? 50-50 how we are going to work it out? It's the future cash flows. Okay, how gains and losses, all this will happen. So the one of the requirements is you have to identify what are the foreign operations, and according to that we should make it a point. Okay, now these are the summary. Okay, I advise you that whenever you complete the things, just follow these points. It will really make sense. Okay, the same thing is there. What is the functional currency and what is the presentation currency? Please subscribe to my channel, share my channel, watch till the end, post your comments. Okay, these are most important thing. And whatever is feedback, just post the feedback in either way. How much you liked it, where we can improve, and where we can make it more interesting and more. See, actually, it should lead to results. Okay, thank you so much. Best of luck.